Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Michael Hironimus with Duckridge Realty Services. He provides private asset and portfolio management, market analysis instruction. He's an instructor for market analysis, and he's also a CCI M chapter president. And in just a minute, we're going to speak with Michael about the current commercial real estate condition and the various asset classes, and try and look beyond the current situation and where things might go. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. And also, if you'd like to see how handsome our guests are, you can check out our YouTube channel. And that is Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Michael. Welcome to CRE PN Radio.
Thanks, Darren. It's a pleasure to be here, and thanks for inviting me.
I'm looking forward to our conversation today. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I actually started most of my professional career. I started in insurance. Actually, I was started a insurance company with a friend, and we did it just before Hurricane Katrina hit. We did public adjusting, and went out and I was working with a lot of commercial property owners, working on their what was a disaster at the time, and but there was a lot of people that were just sort of, regular folks that had invested in commercial real estate and done really well for themselves. They had large apartment complexes, and they were truly concerned about their tenants and getting things back to normal, of course. And that sort of spurred my interest. I didn't really know much about real estate at that time, and spurred my interest in getting into commercial real estate. So when I got back, I moved into commercial, started doing some advisory work, and that's when I started investing. Got my first investment property back in 2006. And then I decided, well, the best place to figure out where the deals are at would maybe be to be a broker and understand where the deals were or how they were flowing. And so I started doing that. I worked, mostly I did retail and industrial down in the San Francisco Bay Area where I was from. And then about 4.5 years ago, I moved up here to Oregon and got my CCI M designation, which was very important for me. Once I got my CCI M education, I realized all the things that I didn't know at the time. They always say it's not what you know, it's what you don't know. And CCI M really opened my eyes to a lot of the analyses that go on and being a true advisor instead of just a transactional broker. So that was great. So when I moved up here, I started my own company, Duckridge Realty Advisors, and really focused on the advisory side of things. That eventually morphed into doing portfolio and asset management, meaning we look after high net worth clients' portfolios, actively manage those for them, oversee their property managers, do financial and market analyses, and so forth. How I equate it to is kind of wealth management, if you will. You always talk with a wealth manager on the equity side. I do it mostly on the commercial real estate side. So that's what we do. That's kind of how it's evolved over time. And I also teach now for CCI M Institute globally. I teach market analysis for the Institute, and that's been great, connecting with people around the world, and just sharpening my skills. So
Awesome. No, I appreciate you sharing your background there, and it is interesting the eye you get into real estate from an insurance vantage point. I think I've similarly were curious about real estate myself as I saw some of my customers establishing portfolios or acquiring properties and that, and like, that's pretty good stuff there. So I can appreciate that. Um, so you and I, we've met a couple times, and you have I believe it's a quarterly meeting that kind of got interrupted with the COVID, but you also put out a quarterly newsletter. And the most recent one that I saw kind of caught my attention. That was kind of the impetus for inviting you to appear. And I thought maybe what we could do is kind of go through just some of the current economic conditions and how they have affected the various asset classes, and kind of what your outlook is as to how things have changed, and what the future kind of near and far look like from your vantage point. And I think one of the things that obviously we're recording this here in December of 21, we're still dealing with the pandemic. It's created all sorts of interesting situations, with supply chain issues, and also just the way people are doing work, more of a remote base than previously. And so I wonder if there's a starting point that you have, or there's like some additional information that you look at when you kind of view the different asset classes, whether the jobs report, interest rates, government policy, any of that kind of factors into your viewpoint.
Well, yeah, it all does. When you're talking about sort of looking into the future, we try to do what's called gap analysis, looking at the current supply and then sort of trying to forecast increased demand, and see if there's a gap there, whether it's negative or positive. The thing is it all starts with jobs, really. Jobs, bring in people, people bring in money, and that all filters down to the different asset types. One of the things that's sort of thrown a monkey wrench into it, and as you're alluding to, was the COVID pandemic, where there was this sort of work from home change that occurred, mostly in office, but also in retail, where there was some companies that went to more online sales. Restaurants, of course, were one of those as well. But it was just a shift where now you're suddenly thinking about different types of demand drivers that maybe weren't there before, just in terms of, well, we used to take what was called, the gap, the demand for office space. Let's take, for example, you usually look at when you're looking at the labor statistics reports, you're looking at, kind of the fire sectors, as we call them. That's finance, insurance, real estate. You also look at government services and, professional sectors. And so you look at it and you say, okay, well, how much space are they taking up? Sort of square footage per employee. And so let's say, just for an example, per employee on the office sector is 250 square feet per employee. Well, in the past, you were able to sort of extrapolate that out. Okay, well, what is sort of the future forecast demand for increases in those sectors, and extrapolate that out over square footage. And then you look at your metro area. Well, how much square footage is in the market? And then you kind of see that gap. Well, it's sort of been sort of turned upside down, especially in office, a little bit of retail, where it's difficult to forecast those things now because, well, what percentage of those workers are actually going back into the office? And what sort of threshold is there for these companies to keep that office? So it's really difficult to do analyses, particularly for office and retail. Industrial and multifamily, it's not as big of a deal, but there is some risk there on that side. And I don't think it's all been thoroughly fleshed out at this point. There are companies that don't even know what they're doing in terms of work home policy. There was just a report that came out that said that Google is telling employees to come back at the end of January, and now they've extended that with this new, variant that's coming out. So, there's still a lot of state of flux if you're looking at across the different asset factors. You get into industrial supply chain issues and so forth. But hopefully these things start to get worked out. There's still quite a bit of risk out there in terms of understanding where these markets are headed. But there's some positive things out there as well. So hopefully that answers the question.
Yeah, no, I think that it's just kind of a state of what is, and just that uncertainty that kind of underlies it. I'm kind of curious, with some of the asset classes, I've heard of some conversion from use from one to another, i.e. the hospitality. I've seen some conversion from hotels to apartments, or even some big box retailer like malls and stuff. I think there's been some conversion. Have you seen much with respects to office? I mean, is there any movement afoot to convert office into, I don't know, multifamily or other?
Not that I've heard of, not on a large scale. The differences between multifamily and office are the differences in the internal systems of, with office space, you need, a couple restrooms per floor, and, multifamily, obviously you need restrooms, in every unit that's up there. So there's a difference in the systems, plumbing, HVAC, those sorts of things. And I'm not sure that a lot of developers sort of get those things to pencil all the time. You're talking about big box retailers. We have seen some conversions, some to retail, some to fulfillment centers and so forth. I think a lot of that is regionally. It just depends on your land values and so forth. Here in the Portland Metro, I haven't seen a lot of that on the ground in terms of those conversions, but there certainly are different buildings that are taking on different lives for themselves. Talking about looking at the Lloyd Center now, where that's headed, probably going from a mall to some type of mixed use along with residential and some retail. And so a lot of these older facilities are getting a new life, which is good. And rethought, and hopefully with a lot of housing in mind, because we are obviously very undersupplied here regionally as well as nationally in terms of housing. So
Yeah, no, that definitely is kind of a one I guess bright spot as far as demand. Housing is demand is definitely strong. So let's jump into kind of each one of the asset classes here, if we could, and talk a little bit about where things are and where you think, based on the current situation, things are going. What if we start with, say, industrial? Is that a good place to start? Or
sure, yeah, start with the bright shining star.
Yeah, start with that, and we'll work our way down.
Yeah, I started brokering industrial back in 2009, and this was sort of just coming. I guess it was right at the peak of the Great Recession, and Industrial was not very sexy, I guess so you say. Back then when I first started, industrial was looked on as sort of a dirty product. If you were an investor, you certainly didn't drive people past your industrial building and point it out. Everybody wanted to be a multifamily, and obviously that's changed over time. As the internet progressed and as e-commerce emerged, industrial has taken on really a new pillar for our economy. Industrial continues to perform really well. Rents continue to rise nationally as well as locally. Here in Portland, we're running a vacancy rate of about 4.5%. That's more or less in line with the national vacancy average. And you're seeing, rents anywhere from, 80, 90 over $1 triple net here locally, which is a considerable increase just even pre-pandemic. Cap rates, if you're looking at cap rates, they continue to either remain stable or decline. I would say where we're seeing a lot of cap rate compression is on the institutional assets. Institutionally, there's a lot of money still out in the market, a lot of liquidity, and they're looking for places to park that. Industrial seems like a pretty safe bet in those terms. So you're seeing some cap rate compression on institutional assets. It's funny, I don't know if you know Prologis, but Prologis is pretty much the largest landlord of industrial real estate throughout the United States. And their CEO about 3 or 4 weeks ago came out and said they were essentially sold out of product. They have a 1 to 2% vacancy rate, and that can be attributed to just people shifting spaces, if you will. So that's pretty significant when you have the largest landlord in the United States come out and say they're out of product. And it just tells you about how consumer habits have shifted. When you look at the share of e-commerce that's risen, there's just going to be continued demand, I think, as people get more comfortable shopping online. The other thing, and you talked about the supply chain issues, there's been a little bit of shift in thinking in those terms. There used to be, and Prologis had actually come out with a report on this, there used to be a thinking pre-pandemic where it was just-in-time delivery, JIT delivery, where it was, okay, well, the products are coming out from overseas. They quickly go through the warehouse, and then they're quickly distributed out to their close-in facilities or directly to the consumers. That began shifting even before COVID as supply chain issues sort of ramped up. And now they have what's called just-in-case delivery. And just in case means that there's more supply being stocked onto their shelves just in case they can't get any shipments from overseas. And that's just to, satiate the consumer demand on e-commerce. And what that does is okay, so if you're just keeping more inventory in your warehouses, that means that you need more warehouse. And they're anticipating that could put another 10 to 15% of demand overall on the industrial sector. So I think industrial has room to grow. There's still a lot of demand out there, and frankly, the supply still hasn't caught up even at this point. So
I was going to ask you, you mentioned the 4.5% vacancy rate. I know like in, even like multifamily and stuff, that's almost like full because it's more transitory. You're not vacant as much as you have somebody move out and you've got somebody moving in, and
that's right.
Is that kind of similar in the industrial? Is that
yeah, that's pretty much right on. Some of the vacancy, within industrial, there are subsectors. You have warehouse and distribution, you have manufacturing, you have flex. I would say maybe some of the vacancies coming on the manufacturing side, which has been a little slow to grow after the pandemic. But warehouse and distribution assets, the vacancy rate is remaining low. And like you say, it's more of companies moving to and from other spaces and whether they're expanding or contracting. So yeah, it's essentially we're sold out around here too. Every once in a while you'll see a spike in vacancy, but that's usually because there's been a delivery onto the market of an industrial asset.
So thinking this through just a little bit, if we go from a just in time um, philosophy for the supply to now just in case, uh, do you see more of the I guess the inventory is growing as well as more of the actual manufacturing or the source of the product being brought on shore to um, kind of overcome that, or is that are we still is it still cheaper to produce goods overseas and transport them? Um, is there a shift there? I mean, I'm kind of curious about that.
Yeah, I mean, now you're talking about economic policy and, is there more onshoring going on? I would say there is, and that's being driven by, a few things. There's a lot of economic unrest with China. Whether we agree with all of their policies or not, obviously the supply chain is pushing that. I think there is a push to do more onshoring of manufacturing, but if you look at the labor statistics, at least locally, um, we're not seeing a huge increase in manufacturing employment, unfortunately, at least regionally. Um, but that being said, I hope there is. Manufacturing is a huge driver for us in terms of basic job employment and bringing dollars into the local economy. Um, Hopefully, manufacturing continues to increase, but we'll see. We'll see how it pans out, I guess.
Sure, and even along the import um, strategy of doing business the way we've done, um, it seems like if there's such a bottleneck in Long Beach or the primary ports, it would give an opportunity or present an opportunity for some of these lesser ports, i.e. Portland, to I don't know, become a solution or a source of importing. Anything like that you're seeing, or is that anything on the horizon that you hear talk about with that, or?
No, I don't. I think a lot of the ports are just packed right now. Some of the smaller ones, maybe are soaking up some of that, but it really comes down to where the product needs to go and how it gets there. You talk about intermodal travel and it's difficult right now because there's bottlenecks pretty much everywhere. You talk about labor shortages, you talk about increases in supply costs. I can't say that there's one thing that is holding everything back. It seems to be like a whole cocktail of different things that are holding back this bottleneck in supply chain. And from the reports that I'm reading, it's probably not going to go away anytime soon. So once again, that's just going to put more pressure on our industrial assets overall.
Got it. Well, it sounds like the near future is pretty bright for the industrial based on, you know, um, demand where you can't see the end. It's just,
Yeah,
uh, for at least the next couple of years, because even if this thing starts to figure itself out, and it sounds like there's kind of the shift from the just in time to just in case, that would obviously create more demand for the space. Uh, and as people kind of shift their buying habits from in store and they get more comfortable with the online, uh, certainly makes a good case for the industrial. And if more of the manufacturing comes on shore, I think wouldn't that naturally absorb some of that industrial, or is that,
yeah.
or do you, yeah.
Well, manufacturing is sort of a different build a little bit. They rely more on power, maybe less on docks and clear height than warehouse and distribution does, but you're along the same sense. One thing that we have regionally, or at least in the state, is sort of an artificially constrained supply in the urban growth boundary, and so that will probably continue to be a force in where new construction is being built, and probably put further supply constraint on in the near future. But I think the risks would be if there's a big slowdown in the economy and consumer spending, and or if there was if industrial started to get overbuilt. But at this point, just looking from the fundamentals, it doesn't seem like that's the case anytime soon.
Got it. Let's talk a little bit about retail. We kind of touched a little bit about how the buying habits have changed, but what is the current state of national and local for retail?
Yeah, I think you sort of have to disaggregate the retail. Malls have been beat up. Those are places where there was large amounts of debt, and not a lot of consumers were in the large malls. You see mall failure and defaults nationally. But I think some of the other types of retail, particularly grocery anchored retail, ended up doing pretty well and remaining stable through the pandemic. Locally, rents pretty much remain stable. They declined just slightly, but they're pretty much back up to where they are pre-pandemic level. They're running about $20 a square foot annually. But if you look at it, talking about industrial, office, multifamily, there was large increases in pricing and revenues. But retail, it was sort of muted. When you look at nationally, prices were up, they're just up 1.9% over pre-pandemic levels. And revenues are up about 2.2%. So there wasn't this build out of retail. It's not oversupplied. And so I'm sort of bullish on retail. I think that there's good opportunities in retail with well-located assets that have a good tenant mix. I think the tenant mix and the focus on experience are the most important things in retail. People, we're social creatures. I think people, despite the variance and everything, people still want to go out. They still want to have a good meal. They still want to be with other people. They still want to try on, clothes. They still need to get their hair done, nails. Those things you can't do online. So, having a good tenant mix and focus on experience, I think there are opportunities in retail still. And I think that is one of the asset types that I think has room to grow, as long as consumer spending remains at the levels that they're at.
So when you said you're bullish on retail, and I'm just kind of thinking of, and even pre-pandemic, there was kind of the death of the malls was kind of a foot as far as the just they were having to change their way, trying to create more of an experience kind of thing.
Yeah.
When you're assessing this, you mentioned a good tenant mix and good location. Is there anything that outside of that? I mean, because I'm just thinking like having grown up in the Midwest and seeing the mall where I bought every pair of Levi's be destroyed and redeveloped to a Lowe's. Now I'm like, are you kidding me? I mean,
yeah.
But just the, I think like you said, if a retail center has grocery being a good anchor and a build, I mean, those seem to be doing very well. Is there anything outside of that? Or is that pretty much that's as simple as it gets? You got to have that good tenant mix and a good location.
Yeah, I mean, you also want to be in areas that have good demographics, good what we call psychographics, which are spending habits. You want to understand where the demand and what those consumers are looking at, what's their discretionary spending, and you want to make sure that those line up well with your tenants. We do those sorts of analyses where we look at, okay, well, if a tenant is looking at coming into there, once again, what is that gap? Is there demand for that type of tenant, and are they going to be a good mix in terms of the other tenants that are in the property? But going back to fundamentals, place with good visibility, places that places that have, or retailers that have abilities to fulfill online orders, I think are going to be more in the future. We're seeing a lot of people that are a lot of properties that are moving towards more of drive-through retail, which I think is going to get even more popular, where you can go through and not just get a coffee or fast food, but you can drive through and pick up groceries, or drive through and pick up your jeans or things like that. I think that you're going to see more of that in the future, and that's going to change how the layouts are for retail in the future. I think we'll see different types of layouts and new development in the future for retail. But once again, I think retail has a bright future ahead. I think the death of retail has been a little overstated. Not necessarily in malls. Malls have been having a tough time generating traffic, but good retail, neighborhood shopping centers, power centers, they should do well, I think, in the coming years.
Got it. We talked a little bit about office. Is there anything more that, with office, just is it pretty much based on, how people are working? Are they coming back? Is it just more of an uncertainty, or is there anything we didn't talk about there with office?
Well, I mean, office is I think probably holds the most amount of risk right now, just in terms of what companies are thinking about in terms of balancing this work from home. What do their employees want? I think you read reports, and one report will say, oh, everybody wants to come back, and one report says, oh, everybody wants to stay home. I think it's going to be somewhere in the middle, where there's work from home flexibility, where people can go into the office if they have an important meeting or want to collaborate with their team members. But maybe they also want to stay home and work in their slippers, or stay home with their dog or their kid who's in school. It's going to be more flexible. And once again, that creates a little bit of difficulty when we're trying to understand and forecast demand in office. Castle, which puts out a barometer, Castle Barometer. Castle's the company that does the key cards that, for getting into your office and getting into buildings and so forth. And so they track, people that go through. And right now we're only at about 40% occupancy nationally in terms of people going back into the office. So we're still well below pre-pandemic levels. Vacancy in the Portland metro area is running about 16% on direct vacancy. It's stabilizing, luckily. We had a ton of sublease space that came on late 2020, early 2021. Luckily, that's starting to stabilize, and our vacancy is stabilizing. But really, the vacancy rate, I think, is much higher than that when you factor in some shadow vacancy that's in the market. You look at some large buildings downtown. The Bancorp buildings running, they have about 350,000 square feet vacant. Wells Fargo's got 150. The Coin Tower's got 125. 6th and Main's got 150. So you look at these buildings that are downtown that have a lot of vacancy still, and it's going to be difficult to absorb all of that, at least in the near term. I think it's going to take a couple of years to get back to some sort of stabilized vacancy rate that we've seen in the past. And once again, I think that script is still being written as companies wrestle with the work from home policies.
Yeah. No, it's interesting. I know, earlier you'd mentioned kind of the average square footage per person. I think you said around 250 square feet. I'm kind of curious, we just kind of talked about the space used for retail being kind of reconfigured. If you think that the the space for office will be reconfigured, plus or minus. I mean, because like, if we're in this continuous cycle of the new version of whatever the pandemic presents itself as, and we're trying to create space, could it be that people get more comfortable coming back, but just to be safe, we increase the space, or is
Yeah.
that, I mean, it's kind of, I hadn't thought of that till just we're sitting there talking, but that, I mean, seems like, at least, I don't know if it would mean that you would, or possibly that you have a reduced workforce on site, but you have more space per person, which basically nets out the similar square footage demands. I don't know. Does that make any sense, or is that?
Yeah, well, so if we think back to, let's say, the early 2010s, around 2010, there was a real shift in office to go from sort of the old cubicle style that we had thought about traditional office to more of open collaborative spaces. When you think about tech, there was these bench style office seating in more of an open air area. There was much less demand for private offices and cubicle space. I think we're going to actually maybe go back and revert a little bit. And the other thing is just how office landlords look at this safety measures for tenants. These touch spaces, keyless entries. We're looking at increases in HVAC for better air circulation to get out some of these, vapor particles and so forth. And I think the idea is to try to make it so that people feel safe going back into the office. And I don't think it's going to be these big open air necessarily spaces. Maybe it does go back to more private offices where people are sort of sheltered a little bit, but it's going to be interesting to see how that, like you said, the price per square foot for employees, they were starting to pack them into offices, and there was concerns at one point there was going to be a stress on the office systems. I think it's going to go in the opposite direction now, where office employee per square foot is going to start increasing as people want to sort of have a little more shoulder room. And as people are actually in the office, I think there's going to be less people in the office at any given point than there was in the past.
Yeah, no, definitely be interesting to see where it lands. Let's talk a little bit about multifamily.
Sure.
It's been kind of the one of the demand or most in demand products. We touched a little bit about the demand for housing. How do you see the multifamily housing, and do we have any lingering effects from the moratorium on evictions, et cetera, or are we past all that?
I think in some pockets, perhaps there are some lingering effects to that. Surprisingly, overall, with some of the stimulus that went through, there really wasn't a large decrease in rent collections, and that's nationally as well as locally. We really didn't see a lot in terms of defaults, which were expected, and so forth. In fact, the opposite has been true as labor shortages and cost of materials increased. Multifamily construction sort of declined as there was continued demand on multifamily construction. Increased year over year, about decreased 45%, I believe, locally for multifamily. And that's a little bit concerning. Part of it, once again, is the labor shortages. Part of it is increase in material costs. Part of it is some of the governmental regulations, talk about rent control and inclusionary zoning locally. There's been a decline, which isn't good. That's only going to put more pressure on rents and prices per unit increasing. CoStar in September reported that Portland had the 5th fastest declining vacancy rate among the top 50 metros in the country. So that's pretty significant. Portland had a lot of demand despite, sort of limited supply. And it makes sense to a certain extent, because if you think back, a couple of years, it takes a couple of years to break ground. You've got to go through planning and zoning and so forth. And if you think back a couple of years, well, that's when almost the start of the pandemic started. And so I think there was some sort of a hiccup there. I think it's going to increase again. Multifamily will come back. Hopefully we get the labor shortages figured out. People start going back into the workforce. But I think multifamily is solid. I mean, really solid. You're just seeing huge price increases. Rental increases are going up nationally as well as locally. And I think it's a great asset class for the future. If the Fed increases interest rates significantly, which they're starting to telegraph a little bit, that might put future home ownership out of reach for some folks, which will just further exacerbate the problem in demand for multifamily. So I think multifamily is still got room to grow, still got room to expand. We really need more construction, and we're severely undersupplied, both in Portland and in the state overall. And hopefully these state governments and local governments start to figure that out and incentivize developers to increase, because that's the only way we're going to get affordable housing and suppress these rental rates.
Yeah, no, that's always been kind of a head scratcher. Some of the local politics and how a simple economic, balance is supply and demand, and it seems to me that's a pretty simple one to see, but it seems pretty difficult to enact. I mean, if you want to overcome this shortage, if you flood the market with product, you would essentially, accomplish that, but that's not the direction they've chosen to head. So
yeah, well, you had the rental, the first in the country statewide, rent control, and then Portland sort of doubled down on the inclusionary zoning policies. So anything over 20 units, you have to have 20% for low income housing. And what that really did was that, include that with, once again, labor shortages, cost of material increases. It just didn't get a lot of development to pencil anymore. You take the land costs that are increasing in Portland metro area. And so there's no surprise that there was a severe decline in construction in downtown Portland. And so their policies essentially did the opposite of what they were trying to do. Instead of getting all these affordable housing units on the market, it essentially shut down construction for most people because it just didn't pencil. And so, unfortunately, politicians are passing laws that do the opposite effect of what they're trying to accomplish. But that's a whole nother podcast that you could do.
Yeah. No, but it's just a constant, frustration, and
yeah, it is.
it's a topic that everybody has an opinion about, and like I said, we could do multiple episodes on that. So
Sure.
For now, we'll stop there. But Michael, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and try and work with my clients to assess risk and determine what to do with the risk. Yeah. And there's three strategies we typically look at. We try and figure out if we can, first, if we can avoid the risk. If that's not an option, we look to see if there's a way to minimize the risk. And when neither of those are an option, then we look to see if we can transfer the risk. And that's what an insurance policy is a risk transfer vehicle.
Absolutely.
And so I like to ask my guests if they can look at their own situation. Could be their clients, investors, tenants, the market, interest rates, et cetera. But take a look at the situation and try and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. But if you're willing, I'd like to ask you, Michael Hironimus, what is the biggest risk?
Oh, goodness. The biggest risk. if you're just talking about the commercial real estate industry overall, I would say the biggest risk that I can think of at this point would be dry up in liquid and access to debt, and a significant shift in interest rates. A lot of the acquisitions that have been occurring have been at, compressed cap rates and so forth. If we have a large push on interest rates, there's one of two things that can happen. Either your risk premium that your cap rates are built upon is going to compress even further, which is probably going to drive people out of the asset type, or you're going to have increases in capitalization rates, which is going to have severe effects on valuations for all the asset types, really. So I would say that's the biggest risk at this point. The other risk that I think, at least from an investor perspective, and we try to balance this out and be conservative, is that, and I've seen this in the past, we saw this in the great financial crisis, where sort of whatever has happened in the past, people project into the future. And so we have these, great rental increases. You're looking at industrial, multifamily, even, some increases in retail and office, and you go and you try to extrapolate that out into the future. I would say that there's a risk there in that if you're anticipating those rental increases to continue on ad infinitum, that you're probably not underwriting very well, and you may be setting yourself up for risk and potential issues in the future. I would be looking at forecasted demand, looking at jobs, how they're shifting within your metro area, looking at the changes within the different industries that are focused on your asset type, and be conservative in your underwriting, because I think, once again, there's going to be maybe a slowdown in the future. Things can't run 100% hot for forever. So once again, if these supply chain issues continue, and if interest rates expand, it may signal a cool down in the economy, and those rental increases may not continue in the future. So I would say one of the biggest risks is just, be conservative in your underwriting when you're doing your acquisitions, and make sure that those rental increases make sense, and buy on actuals today. Don't buy on anticipated returns in the future.
Always good advice, but in the heat of the moment, when there's demand, sometimes hard to hold to there.
No, I know. You just got to stick to your principles, because I think people that stick to their principles on investments, they can hopefully weather the downturns better.
No, agreed. Michael, where can listeners go if they'd like to learn more or connect with you?
Oh yeah, great. You can always reach out to me. I'm on LinkedIn, or you can go to duckridgerealty.com. I also, as you mentioned in the beginning, I also run a society. It's called the Oregon Society of Commercial Investors. That's where I put my quarterly reports. And pre-COVID, we would get together quarterly, but that's at orsci.net. You can check that out. We've always got articles and quarterly reports, but yeah, love to connect with anyone out there.
Cool. And all of that will be listed in the show notes here. And so if you'd like to connect with Michael, I encourage you to do so. Great information and insight, as always. Michael, I can't say thanks enough for taking the time to talk today. I've enjoyed it and learned a lot, and I look forward to doing it again soon.
It was my pleasure. Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening. to Commercial Real Estate Pro Network's CRE PN Radio.